I was on the a monthly time frame, and what I was basically doing on this monthly time frame is that I was marking off areas of interest. Okay, so I was marking off areas of interest on the monthly time frame, and why having those areas of interest or marking off those areas of interest actually serves as a very important part or perspective in us understanding our trading, right? So I was obviously making, reference points to what we are currently over here, which is this green bullish candle, and then we see this bar. Now I was saying that this bar and this bullish candle, what happens is that they hang tail in the market. Okay, so what that basically means is that they've got the same kind of information in the market, right? And this for me is like very, very important. Okay, so I marked off my previous month high. Let's try this thing again. Network today is not in my favor. Okay, so let's go again. Let's see what happens. So I obviously marked off these levels, right? So this was my this was the high of the previous month. This was the low of the previous month. Why I did that was because I'm of the understanding that okay, all right, let's go. Let's go. Hope you guys are ready. So I'm of the understanding that obviously our highs and our lows of the candles are as what we would then define as our institutional numbers, and then we've got the open and the close price, which is then what we would call institutional extensions. Okay. So this would be our institutional extensions, the open and the close, and then the high and the low would essentially be our institutional numbers. All right. Are we together, guys? Are we flowing together? I'm going to need you guys to be quick. I need you guys to be quick in answering. Yeah. Are we guys together? Are we guys together?
Yes, sir. Yes, sir.
Yes, sir.
Thanks, guys. Let's go. Okay, cool. So for me now, this is very, very critical and important, okay? Because it helps me to build and understand a bias model in terms of where the market is likely to move off to. And then in simplitude, then what I did was I then moved from my monthly time frame and I went to my weekly time frame, and I did exactly the same thing on my weekly time frame. So you'll notice that it's always previous, right? So this is my previous week, as you guys can see over here, and this is my current week candle. So this is my previous week candle. This is my current week candle, as you guys can see, right? So this is my current week candle over here, and this is my previous week candle. So I did this thing even on the previous month. So if I'm now on the weekly time frame, I can see that my previous month high was here, and my previous month low was here, and then I had these extensions, which was the open price of the previous month and then the close price of the previous month. Right? Now, why that is important for me is that price will always move or tend to move or gravitate to move towards these areas. Okay, so what happens basically in a market structural reference points, okay, if you are looking for large shifts in price, you must understand that where they originate from, okay, from say a monthly or from a macro monthly bias, okay, you will notice that they originate from their highs and their lows. Sometimes they originate from the open and the close prices. Okay, so the high and the low would be the institutional number, and then the obviously if I go to my monthly time frame, okay, the open and the close price is then what we would deem as our institutional extensions. Okay, and I'm always marking out the previous because it's going to give me a framework as to whether what the next month is going to do if I'm looking at the monthly time frame. So price action here was actually very interesting from a higher time frame narrative. Now, here's what I said to you guys, okay? I said that one thing you must note is that the market is always moving from the market is always moving from a PD array to another PD array. So that basically means is that the market will move from an order block to a fair value gap. The market will move from a fair value gap to a fair value gap. The market will move from a fair value gap to an order block, vice versa. Okay, and for me, I think that is actually quite interesting, right? So from a long-term idealistic perspective, look at what happened over here. We're at this fair value gap. Fair value gap is a 3-candle formation. For some of you guys don't know. So 1, 2, 3 with with the market is offering just one-sided narrative, of which the one-sided narrative that it's offering here is that it's offering buy side, but it's not offering sell side. So what would happen is that the market would come and then it would need to rebalance this imbalance in price action. Okay, once it taps into this area and rebalances the imbalance, okay, and then it reverses in opposite direction. So these fair value gaps at times, they act as key levels of support and resistance. Okay, because whenever we tap into these high time frame perspectives, then the market would then want to reverse in sentiment, of which this is what we're seeing the market doing over here. Okay, where we had this fair value and then we're offering buy side. Now, the reason why it's called a fair value gap is the fact that, you want fair value in terms of price delivery. So what that means is that if the market is offering buy side, it needs to come and rebalance this imbalance in price movement. Because if it's offering buy side movement, and the market is going in one direction, when it comes back, it needs to rebalance this. So when it comes back and rebalances, then this imbalance that was created here is now rebalanced. This is then what we would call or term as a fair value. The market offering fair value. That's why we say that this is a fair value gap. Same thing as when there's an expansion in price movement. That's what we call a void in price, right? So you got this liquidity void, which is an imbalance, and the market will always come back to fill in that void. So the question always then begs us to ask is that why did price expand largely from that? Okay, what is the originator, or where is the originator of price? Those are the certain elements, that we basically want to know. Okay, now watch and listen to me very, very carefully. Okay, so the market obviously was reacting from this fair value that we created on a high time frame. Now, what I always say in the market is that when you're in doubt, you need to zoom out. A lot of times you don't need to trade every day. Day trading is not trading every day, but day trading is coming and looking at higher time frame ideas. If the market is not reaching your high time frame perspective, then maybe you might consider not trading. For example, a typical example would be, well, I'm seeing that the market is actually offering a bullish move, towards this area of interest over there. What is this? This is a monthly order block. Okay, this is a monthly order block, right? So the expectation, obviously, then would be for the market to trade up into this level and then maybe go to the downside. Somebody else then would say, okay, well, cool. I'm not going to trade up until the market gets to this level. I don't care if it takes me 2 days. I don't care if it takes me 3 days. I don't care if it takes me 5 days. Once it does that, then I can start looking for selling opportunities. These are your most high probable setups that you'd basically get in the market. Okay? These are most your high probable setups that you'll get in the market. And remember, guys, what I'm saying is that this is still, from the beginner, trading session. Now let's go. Okay, now listen to what I'm going to say, right? Everything, every single thing, okay, that you are looking for in price action basically is found on this and this. Everything. Once you understand the dynamics of what is happening over here, you don't need to use technical indicators like relative strength index and all of these things. That is why you'll never see any indicators on my chart unless it is an indicator that basically helps you to to track maybe the different kinds of sessions on the particular day, or it's an indicator that helps you to learn about macros. Okay, but for me, on a personal level, I would not really consider or let me rather say I don't consider trading indicators. Why? Because they're lagging. So anybody talk about relative strength index, not that it doesn't work, not that this line crosses this line and this, but for me it's lagging. And for me it's like, how do you get to understand the market for what it truly is, for what it's, you know, really reflecting? Okay. And if technical indicators help you with maybe making a bit of a direction in your trading, you know, that's fine. That's fine. Okay. Because there's no right or wrong way, as long as it's simple for you and it's well understandable for you. So I don't critique people that even are trendline traders, because we've got trendline traders that are funded traders, for example. Okay. But I want to take you through how do you enter the process of taking, you know, very good entries in the market. So you guys can see obviously that we're reacting upon this high time frame point of interest, right? Which is something that is, you know, quite interesting for me. My obviously larger frame expectation was for the market to essentially trade into this particular area, because this was your previous high, you know, before so it broke out of this liquidity level. So my you know, narrative would have been for the market to retrace deeper into this level, not just take this level out or this low out, but retrace deeper at least into where it actually took out that dynamic swing high. Okay, so swing high is when you have a low on the left, or when you have a, okay, so this is how we basically define it, guys, for those of you who are not basically clued up, right? So if the market is moving like this, now this is where I quickly need us to talk, because we don't have too much time on our hands. Okay, so I want you guys to tell me. You guys can see what I'm drawing, right? All right. So what is the market doing? What is this level? Is this a lower? What are these levels in terms of structure that I've told you guys? So let's go here. What is this level?
Hi,
This
hello.
one here.
Hi, hello.
Okay, try
Hi,
again.
hello. Hi, hello. Hi, hello.
Try again.
Lower high.
Okay. So somebody says that there's a high low. Then what is this then? If those are high lows,
It's a lower high.
Oh,
then what are
yeah.
these? So these are lower highs, right? And then these are lower lows. You guys get me, right? Okay, cool.
Yeah.
So from a very basic structural reference point, okay? So a swing high on this case would be if you have a lower high to the left-hand side and the lower high to the right-hand side, which would basically create your swing high level over there, okay? So what I was expecting, you know, for a real deeper retracement into at least this, because you'll see this thing happening a lot in the market. But I'll teach you guys that when we come to you know, it's part of the sessions that I'll be dealing with in the intermediary sessions, when we're talking about you know, a bit more on certain you know, levels and certain, you know, liquidity dynamics and perspectives and all of these things. All right. But anyways, so let's continue to move. So I'm just going to remove this part. Okay, so let's go. So I marked out my previous highs and lows, as you guys can see. And then what I also did was I marked out my open and my close prices. So this is where the market opened and this way it closed. And it's interesting enough to see that where we bought over here and we created this huge bullish movement upwards was in this level. This was in this close price over there. You guys see, right? So this close price of our previous candle is basically almost the open price of our next candle. So the expansion, you know, to the bullish movement, you know, in terms of price happened, you know, on the line or on almost the same area as what of your close price. And this is why I'm saying that everything that you want to look for in price action is not found in real technical indicators per se. But everything that you seek for in price action is found in your open, the high, the low, and the close price. Every single time. The high, the low, the open, and the close price. Okay. So when you are looking you know, at price, what you do on the monthly time frame is what you do on the weekly time frame, and what you do on the weekly time frame is what you do on the daily time frame. Okay. Now I want you to listen to me very carefully, because this is going to shift now a lot of things. So why I mark these levels off like this is because what I'm doing in a monthly time frame is what I'm doing in a weekly, and it's also what I'm doing in a daily time frame. Because I have got the understanding that if I am to become the trader that I want to be, the only thing or the what I really want to understand is from a deeper sense, I just want to understand the open price, the close price of the candle, the high of the candle, and the low of the candle. That on its own gives me perspective. That on its own gives me perspective to understand what is the likelihood of the market doing, whatever it is that it basically needs to do. Okay, and that is how I basically see my price action. So as you guys can see over here, this was my open, and this was my low, this was my this was my high, this was my low, this was my open, and this was my close. Very interesting enough to see that the expansion to the bullish side was in this particular level. So as we would see it, we would call this then institutional numbers, the open and the low, and then the high and the low, and then the open and the close. This would be institutional extensions. But a lot of what we are looking for in price is found in this piece of information. Because what the market does is that it opens up, it creates a low, it expands, and then it closes on consolidation. Okay, so there is a model that we basically use to sieve out this, and that is understanding accumulation, manipulation, and also understanding the distribution in the market. Okay, so what I'm going to do now, for now, I'm just going to remove this because we're now taking a deeper dive, okay, into what I'm going to be showing you guys. So watch very, very carefully, because what I'm going to be showing you is actually quite interesting. Okay, remember, this is still beginner sessions. We have not yet delved into intermediary. Now let's go to the weekly time frame. And when I go to the weekly time frame, I do the exact same thing. All right, when I go to the weekly time frame, I do the exact same thing. So let's go. Now I'm on the weekly time frame, and I want to find out on the weekly time frame, what is my previous week high, what is my previous week low, okay, and then what is the open price, and then what is the what is the open price, what is the close price, because this is a bullish candle. Okay, and I want you guys to see, right, that price action moves around these levels. So this was my weekly high, this was my weekly low previous, and then we had the open price, and then we had the close price of the weekly. Okay, now I want you to observe what is going to happen. Same thing that I did to the monthly is the same thing that I'm now doing in the weekly. Okay, why? Because the market is fractal. Okay, but when you are looking at the monthly time frame, so when you look at big funds or large fund traders, if you look at the monthly time frame as you guys would basically see it, you would understand that a lot of activity that happens from a higher time frame narrative in terms of large moves, you would either see them on the monthly time frame, on the weekly time frame, or on the daily time frame. Okay, so higher time frames, they provide what we call a macro monthly outlook, or macro market bias. Okay, now there is something that is very imperative in terms of what I'm talking about. Okay, the market will move largely based on monthly highs and lows, weekly highs and lows, and daily highs and lows. So where you want to scout is you want to understand what is your daily high and low, what is your monthly high and low, what is your weekly high and low. From that perspective, you want to understand that if you've got these highs and lows, which are your institutional numbers, you also want to understand the extensions of the institutional numbers, which would be your open price and your close price. Okay, and now this is the monthly highs and lows. Okay, and the open and the close price, and then I go to my previous week. So it's always previous month and it's always previous week. Okay, now remember, our real focus is on this gray area over there, because this is where the order block is. So I'm still considering that the market will trade into this level before it starts really looking for expansion moves to the downside. Okay, now again we go back. Again, I say, if you're in doubt, you always want to do it, you always want to zoom out, right? So this is your high, this is your low, and then this is the open price, and then this is the close price. as you guys can see. I've done that on the weekly time frame. Now I move on to my daily time frame. Okay, and this way things get, you know, a little bit more interesting. So now on the daily time frame, what you are just seeing over here, guys, is that you are seeing, okay, points of interest in terms of what the market has done today. Do you know that we entered a trade over here, and we also entered a trade over here? We caught the buy all the way to here, and then we caught the sell all the way to here. Okay, now this was also based on the outlook that I'm telling you guys about. The fact that this was previous, see this daily candle? This was the previous day's low. This was the previous day's high. Okay, and then this one was the previous 2-day low, and this was the previous 2-day high, and this one was the previous 3-day high, and then this one was the previous 3-day low, right? Because I always want to, you know, drop this 3 days, you know, in a, like I always want to drop the past 3 days. Because what I've seen that is important in the market is previous days highs, and it's also previous days lows, and we've also got session highs and lows, which are very, very important. So when you are now looking at, you know, understanding your weekly profiles and in terms of how the market operates, okay, the reason why you then want to mark off these particular levels is that you will then understand that there is a level of depth when you are looking at the market from this narrative. Okay, because large fund traders, remember I told you guys about you know, a Bank of International Settlements producing a document about you know, forex algorithms or HFX algorithms. Not only then did we delve into that perspective, but then we also talked you know, about the settlement times and clearing houses. So the idea is for you now to get the highest probability entries, which is what a person who's an institutional trader would do to their clients. They would sell at the lowest price, and then they would buy at the highest, or they would buy at the lowest price, and then they would sell at the highest price. Okay, so you want to look what are the most prevalent trade entry models that you can basically get. All of those, where are they found? They are found within your daily highs, your daily lows. They're found within your monthly highs and your monthly lows. Found within your weekly highs and your weekly lows. Now, let's delineate. Look at this orange line. This orange line here, these two orange lines are my weekly institutional extensions, right? So now watch what I'm going to do. I'm going to delve into the lower time frames, okay, because we are dissecting this thing. And I want to show you something very, very interesting when it comes to price action. I'm not looking at anything else too much, but I'm just looking at session highs and lows. I'm looking at daily highs and lows at this particular moment in time. Okay, so what I'll do, I'll go to the 1 hour time frame, and I'll even maybe take a bit of a deeper dive, and I will go to the 15-minute time frame. Okay, I'm on the 15-minute time frame. Now look at this thing, right? Something that is very interesting now when it comes to price action. Check the level that you guys are seeing over here. This level delineated in the orange. Okay, why price is bouncing off this area is because this area is an institutional extension from your weekly bias, okay, of which today, you know, I was very impressed by the trade entry that I saw you know, one of the students in this mentorship actually take, okay, because he took it from an institutional extension idea, which was basically over here, right? Now, the most interesting thing for me is understanding the fact that the market will always bounce, you know, around these levels. So look at the buy and then look at the sell, right? Now, where was my focus? My focus was on this order block here. Why? Because it was on the level where we had our, it was on an institutional level. Okay, what is this? This is the previous day low, isn't it? Now, basically happened is that we traded into a previous day low. Now, not only that, when I look at this even at a much more deeper level, and as per the sessions and the things that we discuss in the, you know, mentorship, you guys see that this was a sweep of the Tokyo low. So there is absolutely almost zero drawdown. from this trade entry all the way to here. This basically gave us 125 pips, right, as a repeat. So the question then being is that why is the market, look at where it reacts, okay? And I'm going to mention this because this is, you know, a sort of cheat code that I would say that we have in the market. We have an advantage. Isn't this an order block, bearish order block to the downside? So both of these trade entries over here, 1, and over here, 2, are based on the same concept. Institutional level, order block on the 15-minute or 5-minute time frame, lower time frame created on the institutional level. 0 drawdown trade, sniper entry. Same thing for a sell. There we have an order block. Here we've got our previous 3-day high number there. Then we've got our previous day high. So we've got 2 strong levels on this same area over there. There's just no way that the market would have just decided to, you know, break out, you know, without actually shorting from that particular area. Are you guys seeing this? Now, I want you to listen to what I'm going to say, because now it's going to comprise of a lot of additional things that I'm going to say. Okay? So without overcomplicating trading and trying to sound, you know, like, without overcomplicating anything, this trade here, simple trade from here to here, okay, 125 pips, sniper entry, almost 0 drawdown on the trade. What did you do? You scouted for, and if you really look at this from a trading perspective, or from a, so this was basically, you know, okay, this was basically you know, what I would call a level where we had like a long-term low, basically, right? A long-term low is, or a long-term high, any point that is our daily high or daily low, those are long-term levels. Remember I taught you market structure in terms of short-term highs, short-term lows, intermediate-term highs, Any point in the market that is a that is on a daily low, okay, it's a long-term. So this was a long-term low level according to structural reference point. But what's very interesting for me is understanding this dynamic that we saw over here. Question: why did price bounce off this region as much as it did over here? Because it was on an institutional extension. No guesswork, right? It was on an institutional extension. That's why it bounced off as much as it did. This level over here was an institutional extension level for what? For a weekly time frame. And look how often the market comes back and it retests this level. Okay? So there's no guesswork, right? Secondly, look how often the market bounces off around these areas. Is it a coincidence that the market turns around there? It can't be, right? Yes, this was an order block, but an order block on what? Order block on our previous 2-day low level. Look at this level over here. Same thing on repeat. Look at this level over here. Same thing on repeat. Look at this level over here. Same thing on repeat. So this was a breaker. It broke above, came back to retest, broke above, collected orders again, and then it just went to the upside. Created this daily level. So these are levels where the market basically trades off from. These are where large orders, okay, these are where large orders are collected from daily highs and from daily lows. So perspective is price is fractal in its nature. Okay, price is fractal in its nature. So by the understanding of this kind of knowledge, it is as if we have got the, you know, the ultimate cheat code to trading. Now, let's take a deeper dive. Okay, so you guys understand now why we are flowing or we are operating within these particular dynamics and these particular levels. I want you to see something for me that is going to be quite interesting, right? Look at the 10 minutes to 4, according to New York Times. There's always aggressive pricing in the market. Why? Because of market on close orders. We're not going to talk about that now, but it's something that I just want you guys to, to basically hold on in your mind so that we can basically talk about it. Okay. Now let's go. Okay. So I'm just going to shift, and then our focus for today is what we are basically seeing over here. Watch very, very carefully. Oh my goodness. Okay. Now watch very, very carefully, okay? All right. So we have got this. This is a bar. Some people can call this a candle. And I said today that everything that we want to see in price action, this is basically where you would find it. Okay. Now, I want us to basically pay attention to what is happening. And maybe we can converse and maybe we can conversate. Because what's going to happen is that this is going to create a picture of what you are then expected to likely see. Do you guys see that everything that is happening over here is not accidental? Look at this, right? Price is bouncing off this level. It's reacting over this level. Is this accidental? No. This was the previous day level. Do you guys see this? Previous day low, that's the previous day high. Okay? 15-minute time frame. Go to the 5-minute time frame. Obviously, will give us more reference points, so more reference ideas. Okay, so none of what we are seeing here is basically accidental. Okay, now I want you to also notice second thing, right? Okay, so price is essentially broken above this level. What did I say to you guys? Okay, I said to you guys that 10 minutes before 4, of which this is what we are seeing now, there's going to be aggressive pricing. I said to you guys before it happened, right? Initially reacted exactly at 10-2. Exactly at 10-4 New York time. There's this aggressive pricing that we just saw over here. Why is this happening? Market on close orders. So hence why I say that if you look at the narrative of price, the large part of importance has got to do with time more than anything else. Has got to do with time more than anything else. You've got a level there, you've got a level there, you've got a level there. Okay, we'll obviously discuss which level you'd basically look at taking. But for me, isn't it interesting how exactly at 10-4 there was this expansion in price movement like that, which then created this particular gap that we have over here. Okay, why? Because of market on close orders. We'll come back to that. Now, I said this to you guys before it happens, because I want to prove to you that none of what we teach is guesswork. Look at what is happening. Okay, I said this before it happens, that at 10-2 in 10 minutes for 10-4 to 4 o'clock, there's aggressive pricing in the market. So what happens is that this move forces traders to either come out of their trades or forces traders to basically take cover. So for the guy that said that, oh well, I might actually look at selling off over there, it actually, somebody will then be stopped out. Okay, but also obviously this is just a manipulation move. But anyways, let's get to the crux of the matter. Now we're going to delve into a bit more detail in terms of what we're going to be saying. Okay, there's a very big difference between engineering liquidity and looking at liquidity from a neutralizing perspective. Okay, so if you're looking at market making and you're looking at clearing houses, for every single buy order that you execute in the market, there must be a sell order. All right. So one of the responsibilities of the market makers is obviously to make sure that there's a pairing of orders that basically happens in the market. Now, listen very, very carefully to what I'm about to say. Check this thing out beautifully and watch it happen for until 4, o'clock. Okay, now look what happens at 4 o'clock New York time. Okay, I want you to be very attentive to time. Okay, exactly at 10 this happened. Before it happened, I told you guys it would happen. Okay, why? I'm not a guesser. We don't play guesswork over here. We trade through what happens. Now look at this black line. Do you guys see this black line that I've put over there? Are you guys seeing the black line that I've put? See this black line here?
Yes, sir. Yes,
now
sir.
Listen to this. All right. Now listen to this. Isn't it interesting how, okay, this black line over here, it is Sunday's opening price. Now I said, remember, there are 4 words you need to hold that will change your life forever. You don't need to care about trend lines and all of this. You can use them, but it doesn't really matter. So you can use trend lines just as an addition after you know what I'm teaching you guys. Okay, just to mark out clarity, just to have a bit more clarity in your chart as to whether what is happening at the moment. But check this out, right? This is Sunday's opening price. Okay, Sunday's opening price, and then I want you to watch. Okay, look at how the market bounces off previous days' highs and lows, and from a weekly perspective, how the market is bouncing off Sunday's opening. Look at this retest. Okay, let's take it a step further. Retest. Look at this break, retest, break, retest. Comes back, trades into a previous day's low. Okay, and then it bounces off actually these areas. This area was the confirmation of this was, I think, as an institutional level, a confirmation of a sell something, the institutional level over there, right? And the market does this on repeat. Now check this thing out, right? So from a weekly paradigm perspective, new week opening gap, and look at how the market is bouncing off all of this. Here it repeats, 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 and then here again it repeats. Why the opening price? So we've then come to understand that market moves are not random. We've got 5 minutes left, aggressive market on close orders taking place. Okay, this is what is happening. This could be potential for a sell order, considering that this is what we have over here. But this is not by way of me giving you guys a signal. I wouldn't trade this because anything can happen at this time. So I would rather leave it. But I'm seeing that this level, it could basically react from this particular, and the fact that we've got a fair value gap over there as well. And this is an intermediate term level. Why? Because it tapped into a point of interest. So this is an intermediate term high. So there will be reaction definitely from this particular level. But anyways, and then if it does break out of it, we'll just come back, break, retest, and then go to the upside. Okay, because it can either do one of two things. It can either break, come back, retest, go to the upside, or it can either break and then maybe come to the downside. If it wants to go further up, it actually will go further up, because there's also on a 5-minute time frame, it could retrace deeper because there's this order block on the 5 minutes. So it could maybe perhaps look at aggressive pricing to the upside, entering this zone, which is this point of interest over here, and then maybe again reacting from this level. So maybe this was not the real move. Maybe this is going to be the real move to the downside. Okay, that's what I would maybe consider. But because it's not in my time and anything can happen, I would basically not trade it, because I trade largely based on time and the session that I'm basically looking at. Okay, so let's leave this and let's watch what it does. Yeah, I'm not saying enter, but it's a very good analogy to basically watch. And obviously all of this liquidity over here is being run out. All of these stops are being taken. Do you guys see that? All of these stops are taken. So maybe this stop also will be taken before the market basically trades to the downside. Now you'll know that as per Dr. I think it's Dr. Swartz, that basically explained that institutional traders will buy or sell where masses put their stops, which is actually very interesting. So you want the stop to be taken and then to sell to the opposite direction. Okay, but we're not discussing that right now. Now look at what we are going to be talking about here, right? Now check this thing out. Now, I want you guys to help me over here a bit. I want us to talk. And I want us to basically, after talking, come to a particular conclusion, okay? Of which, when we do that, you must watch what is, going to happen. And this is how I want you guys to understand liquidity generation, okay? From my perspective, this is how I want you to understand liquidity generation, okay? So let's get the party started. Now, if we've got this particular bar, as we see over here, what is this? According to the OHLC values, what is this? According to the open high low close, if this is a bullish candle to the upside, what level is this? Or what is it?
Accumulation.
Okay. Okay, so no, there's no wrong answer. So this gentleman says that it's accumulation. So I'm gonna write accumulation. Okay, nothing wrong with that. Accumulation, but I want another word for it. What?
Institution extension.
No. If this is a candle, you guys can see this is a candle, right?
The open.
It's open.
Now we're talking. Okay, cool. This is an open price. Lovely. Now we are getting somewhere, right? The accumulation is not wrong. That's definitely not wrong. So this is the open price of the candle. Okay. All right. So here's what basically happens, okay, in the market, right? What you want to look for, okay, on the open price, you want to look for a move away from this open price. Okay, of which this is something that I'm going to show you. So if you're looking or you're considering at having a bullish expansion, you want to trade this, you want to trade the low of this before the heat expansion to the upside. Okay, so this is obviously the accumulation, right? So what this basic accumulation means is that this is a build-up of longs. Okay, so guys, can you just, okay, let's just do this. All right, so the accumulation that is taking place over here at the open price is essentially a build-up of long positions. Okay, so I'll just do this. I want you guys to follow. Okay, so I could say that this is a build-up of longs, right? Because this is basically where okay, so let me just quickly do this. All right, so I just want to, how do I change? Okay, cool, it's fine. So this is a build-up of longs because this is accumulation, right? Now I want you to pay careful attention to what I'm going to say. Okay, then we obviously have, remember we said that this is the accumulation. So whatever is happening here is basically the accumulation. Okay, and this is the open. All right, now who can tell me what this level is over here? What is this level down here? It is the
Manipulation.
okay, what
lowest.
Yeah. Okay, so this is the low. Okay, this is the low, right? Manipulation would be this, what we basically see over here. So this would be manipulation. Okay, from here all the way down here, this is what would deem as manipulation, right? So the gentleman that said that it was manipulation was basically right. Okay, now I want you guys to basically pay careful attention, okay, to what I'm going to say right now, okay, because I think that it's very, very important. All right, so What happens in this manipulation? Remember, this is a buildup of longs. Okay? This is a buildup of longs. But where the actual liquidity is being engineered for these longs, okay, is in the manipulation. So what the manipulation is doing, okay, is that it is engineering liquidity. Okay, so it is engineering short liquidity. So that basically means is that this manipulation move, okay, is taking out previous stops, okay, that were formed in a market trend. All right. So for example, if the market over here was essentially going to the upside, okay, sorry about this cross drawing. Let me make another one. So if the market was going to the upside over here, as you guys can basically see, and then we had this low over there, with this low over there, with this low over there. All of these are stops. Okay, because some traders, basically put their stops. So what the manipulation move does is that it just engineers short liquidity in the sense that it takes out all of this liquidity before the expansion move higher. That's why every single time, you're on the group, you hear Elvis says that liquidity taken, da 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 da. Okay, so what you find is that this engineering of liquidity is that what the market is doing is that it is engineering short liquidity, meaning that it's taking out previous shorts, right? But what it's also doing is that it is neutralizing long liquidity, basically. Okay, so what this means is that if, let's say, for example, there were traders, okay, who bought at the open price, all right? So what the market then would do is that it would drop below the open price. Okay, why? Because it wants to take them out of good positions, basically. Okay, now I'm getting you guys to basically understand the thinking. The thinking of the person that is a market maker is, if my client is coming to me, or an institutional trader, if my client is coming to me and saying that buy me shares on the Nasdaq, for example, because Nasdaq is comprises of 100 tech companies. So in the Nasdaq, I want Tesla shares, for example. Okay, and I call company X and I say, dude, I want Tesla shares of X amount. The responsibility of that person that is working on the floor is to get you, or is to get to buy, your shares at the lowest kind of price. So the idea of what I'm talking about, it's not as if large fund traders are looking at your stops as retail traders, because that's not what they're doing. And that's the picture that, a lot of people have painted. That while stop hunting, they're hunting my stops. Why would large funds, and market makers take your 10 Rand or 20 Rand or 100 Rand in the market and want to hunt your stops in specific? Because remember what I said about the buyers and the sellers, right? We're talking about clearing houses. We're talking about large funds. We're talking about, we're talking about settlements, large funds. We're talking about the market makers. Speaking about banks who are market makers as well, right? We're talking about large funds, when it essentially comes to this. But the general idea and the general thinking is that if I've got a client and I'm trading on floor, the one thing that I want to do is I want to buy shares for my client at the lowest possible price. Okay, now if I am then a trader and I'm sitting, okay, my mind is I'm a trader and I'm a retail trader and I'm sitting at home and I'm sitting on my laptop, okay, and I bought at the open price. Now I'm sitting here as a large fund trader and I'm saying that I want to buy, whatever I want to buy for my client at the lowest possible price. Okay, so there's going to be an engineering of liquidity, to the downside, obviously by large funds. But the general thinking of people says that, well, this manipulation doesn't really have to take place. I think this is a good position. But what normally happens is that the trade below normally takes a lot of traders out, because this is how traders basically think. Okay. And unfortunately, when you're looking at brokerages and you know, some of these guys, they make money when you lose money. When you lose money, that is how some of these platforms basically make money. Okay. So your thinking, okay, your thinking is that, well, this is the open price, right? Of course, because that is the initial value price. But now what you want to find out is on this particular level that you basically see over here, right? You would find that when there is a manipulation move, there is some sort of imbalance in terms of price move. Okay? Some sort of imbalance in terms of price move. And now this move dropping below, okay, is actually then I'm looking for this particular word in English that I can't actually find right now, but I will actually get it. Okay, so when I get it, I'll basically share it with you guys. I use it a lot. I just don't know why I forgot it today. So this is the accumulation, okay, and the original manipulation move is actually engineering liquidity, okay, and it's neutralizing long liquidity. But it's why that is so is because here they're pairing of orders. So for every equal short, there must be a buy order. That is how, you know, trades actually get paired, basically. Okay, now this accumulation is then what we then deem in price action as the institutional extension. Okay, institutional extension. Open price is always going to come with some sort of manipulation before it goes in the upward direction. Why? Because there's an engineering of liquidity. So your highest probable setups when it comes to liquidity that is being taken is when the market opens, and then after the opening price, it then dives lower before the expansion to the upside. This is the kind of real liquidity that you want to look at. Obviously, during this price move, the market will go down, will offer some levels of liquidity, but this is the real move that you basically want to consider when you are looking at looking at your liquidity. Okay, so anybody selling short over here, okay, I got the word. Anybody selling short over here is most likely to be trapped. Okay, is most likely to be trapped. Why? Because this is an inducement. Okay, so this is an inducement basically, and what that inducement is doing is that this is, or what price is basically doing is that it is inducing a short-term trade sentiment. All right, so it will run short-term lows in terms of bias and then expand to the upside. So this trade entry that you could have taken over here as a short will be what we call an inducement. So what is happening is that there is an inducement for longs. So this is just inducing people to come, and they are it's going to take them out of people that bought here, okay, and people that put their stops. All of these stops are going to be run to the downside. Okay, and then what it's going to do is that it's going to induce or engineer a short-term sentiment. So this move to the downside, all that is just an inducement move. I'll tell you why this is important. Okay, so the real buy level that you want to take is after all of this liquidity, after the accumulation move has been run out, okay, which will then create the low, and then it will look for the expansion to the upside. Okay, now watch what I'm going to be sharing with you guys. Okay, watch what I'm going to be sharing with you guys, because this is before I delve onto anything else. Okay, watch what I'm going to be sharing with you guys, because this is very, very important. So this open price here happens before an imbalance in price move. Now watch this. Let me go up. Boom, right? Let me go up. Now I'm going to go back, and I want to go to Sunday's opening price. Are you guys with me? Now, this is Sunday's opening price right over here. This was Friday, and then this is Sunday's opening price. But isn't this characteristic of what we are seeing happening in the market over here? It's exactly the same thing. Okay, let's go back. All right. Now check this out. Sunday's opening price, on the left-hand side of Sunday's opening price, we've got all of this liquidity that is lying over here, right? Okay. So this level is run out, and I'm sure that all of these stops here, let me just check. Yeah, all of these stops here are run out up until obviously the market gets to this level, which was actually a low that was created. Okay, so let me just quickly go back. Okay, so this is an inducement, right? So what the market is doing is that it is inducing a short-term trade sentiment before the expansion to the upside. Now, what I then said was, where you want to get in is after the original liquidity has been run, okay, of which this is what it does over here. And then this is why we call this manipulation. It's manipulation, okay? Why? It's manipulation because all of this short-term, excuse me, it's manipulation because this inducement is the short-term trade sentiment. Okay, so liquidity is being neutralized over here, where sell orders are being paid with buy orders. But also, there's engineering of short liquidity, meaning that all of this liquidity, all of these stops that were placed over here, you know, are now being sell stops, are now being taken, you know, before the expansion moved to the upside. Okay, so what then you need to consider that every single time you open up your week, okay, every single time you open up your week, expect an accumulation, manipulation, distribution, or what we would call a range expansion, okay, a range expansion, and then obviously would have a close. So the range expansion is this move, then obviously would have a closing price. So if you're looking then at the market from a weekly profile dynamic, you want to consider what is happening over here. And guess what, guys? This thing happens every single week. Sometimes it happens on a day perspective. Okay? So if you've got your weekly profile written down, or you've got your weekly profile, then it becomes very critical for you guys to understand that the market doesn't just move in a random case, you know, the way that it does. Before it actually does the actual move to the upside, it's going to create a manipulation move to the downside, of which you can take advantage of it by understanding that liquidity is being run. You wait for a market structure shift to the upside, of which this was perfectly, you know, done on the 5 minute. Okay, because this high was taken, and then this high was taken. We came back, traded into this level, and then the market just continued to create a very, very good, you know, expansion to the upside. Okay, so this the what I would call the secret, okay, to understanding the ranges, or what basically happens in the market, is by understanding the open price. So every single time you open up your trade or your day, look, do you have a new day opening gap, or do you have a new week opening gap? What is the opening price? Because likely market is going to induce people to short, but this is only just but a short-term sentiment move for the real expansion that is about to happen to the upside. Okay, now this is obviously looking at the week from a bullish, you know, profile sort of incentive. Okay, and we can see why the market did what it did over there. So what I'm gonna do is, now I want you guys to check this thing out, because it's quite interesting, right? I said to you, focus on the open. Do you understand what level of precision you are getting? Because right now the market is bouncing off this area. But some people might not even understand why the market is bouncing off this area. because this is the open price of the weekly open. Okay, but then why does it come back and bounce off this area then? Because this is an institutional extension. So every single time you see the market reacting upon levels, it is not by mere or sheer accident. There is purpose. And guess what? All of this is money, guys. It is serious money. Because if you can bag 125 pips the way that you did, like the way that we did here, this could literally be taking 5,000 rands to about 30,000 or something like that for you guys who basically like to, grow accounts, right? Or 5,000 rands to even 50K if you, depending on, how many positions that you could open. If you're on a bonus, good or my, 125 pips, that would have been a lot of money. Someone today could have taken 5,000 rands to 50,000, withdraw tomorrow and have a very good time. Now, how many people do you know that can earn that amount of money? Okay, how many directors do we know that can earn that amount of money? So my whole range perspective is by getting you guys to understand precision models. The fact that the market is not just bouncing off these areas because of a random bounce off, but it's bouncing off these areas, okay, because these are either institutional levels, these are either weekly highs or lows, or these are either daily opens, okay, or sometimes session highs and lows. Okay. Now check this out, right? So the open high low close of the day, which is this, right? Open high low close of the day. I'm on the daily. As you guys can see over here. So previous day, which is open high low close, gives you every kind of information that you'll need because the market is fractal. So if you delve into lower time frames, you then start understanding why the market is reacting off of these levels. Look at this, guys. Non-accident. Look at this. How did the market turn around from this level to go here? Open price, weekly open price. How did the market bounce off the same area because it's an institutional extension? How did the market come back into this order block and buy from this level? Do you guys understand what I'm saying? So your high probability trade setups are on these highs and on these lows. But again, looking at scalings, order blocks that are created within the highs and the lows, that is where the secret is. That is where the secret to sniper entries are. That is the way the secret to probability. So instead of trading every single move, you just focus on daily highs and lows. Okay, but you want to find out, then you incorporate things like, for example, Asian sweeps, right? Then that makes you a better trader. Now watch what we're gonna do, right? So this was 23rd of November. This was on the 26th of November, right? Sunday's opening price. So what I'm gonna do is I want to try and see if I can't shift to the previous week. And I'm going to look if I don't have, a gap. And I want to basically see what happened on the previous Sunday. So let me just quickly go here. I want to show you guys this, right? 6 o'clock on Sunday. Okay. So Sunday, I want to mark off 4, 5. So this was let me just see. This was 6 o'clock on Sunday. Can you guys see what happened? Exactly the same narrative. Do you guys see? This was a weekly institutional extension, right? But this level is also Sunday's opening price. Okay, right. So okay. See that? This was also Sunday's opening price. Short-term trade sentiment. Guys can see at 6 o'clock, Sunday's opening price. To the downside. Okay, creates an imbalance, very good and well. Creates a low, right? and then there is an expansion higher from Sunday's opening price. So this move is the actual manipulation move. So there is power in understanding the open. When I shared to you guys about the perspectives of looking at the markets from a time narrative, all of what I'm sharing today has got to do with time and price. All of it. Okay? All of it has got to do with time and price. All right? So the low of the week, if we're expecting a bullish week, mostly will be formed between Sunday's opening price and Wednesday's New York open. Mostly. Between Sunday's opening price and Wednesday's New York open. Now, my question then is, how is it that for 2 days, we've got exactly the repeat of the same thing that is happening? 1, accumulation. 2, manipulation. And then 3, boom, range expansion. Now, what I said is, what the market maker does, okay, is that all of these guys that put the trade on the open, okay, because these are stops, but these stops are taken, all right? But then the market is doing what? It's inducing. So this is an inducement in price. Short-term trade sentiment for people to go long. Now, as a /YouTube guy, if you watch YouTube, which I don't prefer if you are in my mentorship, YouTube videos will tell you that, well, this is a momentum candle, right? It's a momentum candle, so there's a huge momentum to the downside. So the market might continue to go to the downside without realizing that this is actually an inducement for short-term shorts before the actual expansion to the upside. So I'm looking at where can I get the best price to buy from before this expansion. Question is that why is it that this week it is exactly the same, what I'm seeing, as exactly what happened over here? How Q? This is how. Accumulation, manipulation, distribution high. Okay? So where was our focus? Our focus was on Sunday's opening price. Now check. Now, assuming that we caught this trade, and this was a trade that we could have caught, because if you look at the left-hand side of the chart, this was an order block, point of interest here. Boom. Drive it. Bam. That's an order block. Okay. So this was an order block. And you guys can basically see, bam, traded into this particular OP over there. Okay. Just make it more clearer. Not going to erase that. So back test 1. Now let's go to back test number 2, which is exactly the same thing. Sunday's opening price, original manipulation to the downside, then the expansion to the upside. With this logic in mind, that's when then we go to the low of the week. Okay. Sometimes the market will, if the market trades around this area until Tuesday, on Wednesday, it will just rip apart. But here, it ripped apart. So if maybe the market dilly-dallies around this manipulation, Trust me, it will do that on Monday. Tuesday, it might create the low. And then Wednesday, that's when you would expect a rip if it didn't do this. Okay? So what would have validated you taking a trade entry setup for this buy? 15-minute time frame. Let's go to the 5-minute time frame. And let's see. Okay? Simplicity. What is it? You guys see this, right? Obviously here, we're at a breaker, which is over here, right? So intermediate term high, well, short-term high, and what the market did was traded into it, and it came to the downside. Okay? And it came back to a level. What was that level? That level was the open price of Sunday. Random? I don't think so. I don't think so. Okay? Now let's go back to the last one, and then we end our session for today. Six o'clock. Friday, 6. So 6 o'clock on Friday. Boom. Here. There it was. For this huge expansion. Which the expansion gave us this range, okay, to the upside, of which if you had entered into there, let's make a hindsight view, that would have been about 457 pips, guys. 457 pips. Because now you understand that whatever move is happening here to the downside is manipulation. So why does the market first have to move down from Sunday's opening price? Because there's a short-term, so this is engineering liquidity of the short term, but then it gives you a neutralizing liquidity for buys, right? So this is your expectation. And then it ripped when? It ripped on Tuesday. It deleted around this price, but then it ripped on Tuesday. Where was the actual rip? On Sunday's opening price. There. Boom. To the tick. Boom. The question then is price random? I don't think so. I will leave you at this for today. And yeah. So 3 things I want you to notice. When it comes to time and price, always look at number 1, the monthly open. Number 2, the weekly open. Number 3, the daily open price. Are you guys listening? The monthly open, the weekly open, and the daily open price. Because that is going to give you large perspective. Hence why some traders don't trade on Mondays. Because Mondays normally give you a view on what might happen for the rest of the week, if they know what I'm talking about. So you want to look at the daily open prices. Okay? Why? Because the market will obviously move higher or lower relative to weekly perspectives, relative to monthly perspectives. Okay? So if you want to get proper high probability trade setups, okay, is when you have a support area that is within your monthly and your daily or weekly or your daily. So if you have a support that is your daily and it's on the same level as your weekly, so that means that your previous day's high is your weekly high, or your previous day's low is your weekly low. Those are high probability setup. Okay? So your analysis should always be on the focus of time and price. And that's hence what I'm saying, my question is, when you are looking at weekly opens, I'm not considering daily opens, I'm not considering monthly opens, I'm talking about weekly opens. How is it that there is a repeating phenomena over here? 1, Manipulation before the expansion. Over here, 2. Manipulation before the expansion. Precision, number here, 3. Manipulation before the expansion. Is price random? Never. Thank you, guys. I am done. Any comments? And then we close it off for today. So what we're going to do, we're going to back test. Okay? We're going to back test. We're going to back test. Yeah, similar to 100%. 100% ICT. Very, very good mentor. Love him to bits. I've studied all his work as well, actually. Eh? From 2016 models all the way to 2023. Lovely guy. So, so always, you know, guys, so you wanna look at, you know, these ranges in the market. Very, very critical, because they help you to build very biased models in terms of how you trade. Okay, so always make sure that you backtest as much as possible, and always make sure that you do as much as possible work that you can possibly do to get to where you want to get to. Now, I can tell you something for free, my family, is that I do not sleep. I do not sleep. I'm telling you guys right now, after this meeting, I might go on a 3-hour backtest session by myself. Wish I could take you guys along, but maybe not today. Maybe not today. Okay. So always seek knowledge and always work your ultimate self. Tomorrow is going to be a continuation in this, and I want to obviously marry it with a trade strategy that we are going to be using. I might be sharing a completely another trade strategy, but this trade strategy is based on the New York session, not on the and I'm not sure if you'll find it on YouTube again. Okay, but it's things that you'll go into the market and things that you'll see happening live. All right, thanks, fam. Really, really appreciate it a lot. Does anyone want to ask a question or say something, and then I finish off just to get someone speaking?
Oh, of course, King. Of course, King.
Thank you, Dumi.
It's Ndumi. So, well,
let me open up my camera so that I can see you. Go ahead, my brother.
Okay. What I want to check is from what you have said today, because you have been emphasizing the fact that nothing happens by accident in the market. Time is absolutely important, because what you have just explained about the opening price, first starting with the accumulation, and then there is that manipulation on the downside before it really pushes up. Would that somehow relate? Can we fine tune it to a time narrative in relation to the settlement house distribution and all of the clearing house, you know, and the segments? Because you did give us that table. I think it's here on session 2, where all the times are actually noted. So is it possible for us to fine tune it to that? Because what you have been emphasizing is that nothing happens by surprise. You know, the fact that there are times where certain things happen, then it means that those times somehow be linked to that, so that we are aware that at this particular time, this is what is going to happen.
Okay, so what you, that's a very brilliant question, King Dumi. That's a very, very brilliant question, right? So according to you can't exactly say what is going to happen, but you can at least have an idea in terms of where the market is, what the sentiment. So in terms of reaction, you know, you can at least know that, okay, well, at this particular time, the market, you know, might react on this way, right? And for me, that is very important. So if you're looking at, for example, the information that we shared about, you know, those times where you've got like the real-time gross settlements, where you've got or real-time gross settlement handshakes, for example, and then you've got what else have we got there? We've got settlement time, you know, and all of that, right? Yes, when you focus on those times, you will see that there's always a move, you know, in the market, which either takes out liquidity, trades into a point of interest, and then moves in the opposite direction, right? So what I will do is I will try and see if we can't have a back testing session, even if it's like sometime during the week, right? Where I'm gonna put the table up, and then what we'll do is that when that table is up, we're going to go into the charts and see, okay, what happened at this particular time in the market, right? So was there a you know, was there a handshake, for example, that happened? Okay, if there was, cool. So what happened during that handshake, for example, right? So I will basically do that for you, no problem, my brother. So we can backtest the times, and then we can obviously, you know how we trade, you know, based on, you know, time paradigms and time narratives. It's not a problem for me, my king. I think let's do that, because largely everything that happens is time. Everything that happens is time. New York Open manipulation move, time. 3:30 to 3:30 to 20 to 4, manipulation move, which runs out liquidity, trades into a point of interest, and then reverses time. When we're looking at London currency close, again, that's time. 10 a.m. New York, there's always mostly reversal condition in the market. So that those are the things that you basically want to sieve out. So everything happens due to time. Everything happens due to time. So in one of the strategies that I shared on the group, it's like, okay, cool. So between 3:30 and 3:40, this is basically what happens, and this is your expectation, you know, in the market, basically, right? So yes, we will do that, my king. I think that's a very good suggestion, and then maybe we'll just you know, back test it, you know, with those times, open up those times and see basically what happens in the market during those times. Are you okay with that?
No, I'm definitely happy with that, my king. That would be brilliant,
Okay.
because I'm taking from what
Okay.
you have been telling us that
Yeah.
definitely
Yeah.
there are details,
Yeah.
like fine-tuning it to be super
Yeah.
perfect.
Okay.
Thank you.
No
Thank you so
problem,
much.
my king. No problem. And also, one of the ways that you can also consider fine-tuning your model now is by, okay, let's see if I can't clear. Okay, cool. Here's a clear chart. So one of the ways of fine-tuning your, depending on what you're trading, there's always measured moves, right? So let's say, for example, we will obviously talk about, so let's say, for example, Nasdaq. I'm just gonna focus on Nas just for now, and I just want to show you something. But I think something that I spoke about. So let's start from 15. So let's go to 16,000. So let's go to 16,000. So what I'll do is I'll just do this, and then I'll go to 16,125. Oops. Okay. So I'll go to 16,125. So just hold on for me. All right. So I want you to check this thing out, né? Depending on what you're trading, every currency has a or index, you know, has a measured move perspective. But let me focus on this one. So let's go to 16,000, which is an institutional level, and then we'll go to 16,125. I want to show you something quick. 16,125. Okay, and how the market respects these areas without the fib. And then let's go to okay, so what I'll do is I'll just make it, let's go to 15 minutes, and then I'll go to 15,000 15,000. I think it should be 875, isn't it? So 875, 15,875, 15,875. Okay, and then let's go to let's mark off 15,000. Okay, mark off 15,000. See, now we don't know what's happening on the left hand side of the chart as yet, ne? We're not preview to that, but I want to show you something. So it's 15,875. Let me just do some mathematics. Okay, so let's go. So let's go. So we've got 16,000. Then we minus 125. That's how much is that? That's 15,875, which is good. And then let's go. Then we got again we minus 125, which is 15,750. Okay, so what I'll do, let's just reset chart view. Okay, what's happening over here? Let's okay. All right, cool. Okay. All right, I think okay, let's just go. Okay, cool. So then let me just quickly delete this. All right, so 15,875, and then we'll go to 15,750. Okay, 15,750. I think this is 754. So let me go to 750. 15,750. And then let's go to 15,500. No, 15,625. 15,625. No, 15 years, 15,625, which is over here, 620 over 5. And then what I'll do is then I'll go to 16,000. You see what's happening there? So you're not preview to what's happening there. So this is all that you're seeing there. And then I'll go to 15,000. What 625? Let's go to 15,500. So I'm not showing that the chart because I want to show you some precision quickly. 15,500. Okay, so then the reason why I'm doing this is because so Nasdaq. Okay, then let's go to 15,800. So Nasdaq on its own, right, has got measured moves of about 250 points now. So Nasdaq moves by about 250 points when it does really move, which are the measured moves of Nas. And then what you would basically find is that apart from the measured moves, there are half of those measured moves. Okay, so half of the measured moves is about 125 points basically. So if you look at Nas, now let's go to 1 hour time frame, and you see what is basically happening over here, right? So you go and you just bring this down, and all you just did, you are not privy to what is happening over here, but you just drew vertical lines based on Nasdaq structured measured moves. Because Nasdaq moves by 125 points, look at the precision of this. So this is 16,000, level 16,000. Look at where it bounced off exactly. This is 16,125.
Sure.
Exactly on this level to the key, ne? 16,000 level. Look at here, 16,875.
Yeah.
16,000, 15,875. 15,750. 15,625. If I go to my left hand side, you'll see just that it's not loading now, but it will go. Okay, you will see that market reacts there. Check this thing out. Look at this one. Level 15,500. Look at this. Okay, now let's go 15,500. What is 15,500? So 15,375. What would that be? 15,375 will be over here. 75. Boom. Check that out. Precision, eh? Where we bounced up there. Let's go to 15,000. These are mysteries. So let's go to 15,250. Because Nasdaq moves by 250 points. 15,250. Non-accidental. So how is it that the market will bounce from here to here to here, come here to here, break out, react here, react here, react here, react here, react here, react here, react there, and react there to the T, right? Because this is the measured moves of NAS. So now let's quickly do 15,250. Let's go to 15,125, and then we'll go to 15,000, and then we'll end it off there. So 125, where is it? 125, 24. Boom, 125. Look at where it reacts, which is half of that. And then let's go to 15,000. So let's go to 15,000. So I'll make this as 15,000. And then if I do a tad lower, 15,875. 15,875 would basically be over here. 15,875 would basically be over there. Okay. So then what I'll then do, and then I'll just change this to orange. These levels, the middle levels, orange, middle level. I just want to change it to orange there. And then we've got 15,500. Orange there, middle level. 75 orange there, middle level. Okay. And then we've got 125 middle level there. All right. So but this is too much. Are you guys getting this? Now check this thing out. It's not a joke. This is all mathematical, guys. This is all range moves. This is all range moves. So every single bit you're focusing on an indice, or you focus, hey, there are too many eyes over here. If you're focusing on indice, you're focusing on a, check this thing out. From here, okay, from here to here, look at this thing, check this thing out. Let's go. So let's use our ruler. From here to here, this is about 250 points. Boom. Okay. From here to here, from this one to this one, same thing. 250 points. Boom. Okay. Let's go from here to here, where the market basically reacted. 250 points. Boom. Let's go. From this one to this one. 250 points. From this one to this one, 250 points. And this is exactly where the market bounced off of. Now watch this. So what I'm gonna do, this is all you see. So I'm gonna go to my left hand side. So I'm gonna take this shot. I'm gonna go to my left. You see, you can't see nothing on the left hand side as yet. You see that, right? There's nothing you can see on the left hand side. Now check this thing out. Let's move. Check. Watch. Let's go. Boom. Check. Look at this. Boom. Okay. Check. Look at this. Boom. Check. Look at that. Boom. Check. Look at that. Boom. Check. Look at that. Boom. Let's go. Check. Look at that. Boom. Look at that. Boom. Look at that. Boom. Look at this. Boom. Look at that. Boom. All of it. Precision matrix, my brother. Look at this. Boom. Okay. So what I'm trying to say is there are ways in which you can build precision models, and time is obviously one of them. And this is obviously one of the ways in which you can also explore, building your precision models in the market. Nothing is accidental, and nothing just happens. Okay. So you guys are taking the information out of me now by force, ne? I see you guys. I see you guys. You're taking it out by force. Like, hey, dude, you have to. We want to know this. But yeah, so that's how. So there are different ways of exploring precision models, of which this is basically one of the ways that you can basically look at doing that. Okay. Well, you're still shocked. You look shocked, my brother. You know, when someone asks a question and then they're silent, you must know that they're shooketh about the information. King Josiah's blown away. I'm afraid of you, bro. I'm dangerous, man, but don't say it. That's why I always say you can't compare me with like these. I'm very quiet. I don't post a lot, but trust me, bro. I've been doing this thing for 6 years now. So I know what I'm doing, you know. So yeah, I'm not those celebs. Those celebs. I'm not one of those celebs. So we know what you're doing in this academy, okay? And hence why I said to you guys that I'm producing beef. I meant it when I said that. I really meant it when I said that. Okay. All right, guys. Thank you. Have a blessed night ahead. And yeah, do practice this thing. Go in, look at NAS, like just look at this and just try it out. Even try it out with US30 and see what I'm talking about. Try it out with gold even, and you'll see that measured moves after measured move after. So you can have a chart like this, and you can just make key levels simple for you. Okay. So 250, those are key levels, and then these 125 is middle of 250 is 125. So those are the mid key levels. So you've got these key levels in black, and then you've got the mid key levels, and you'll see that the market really obeys these key levels to the core. Okay. All right. Have a blessed night, everybody. See you guys tomorrow, same time, same place tomorrow. Let's rock this, guys. I believe in you guys, and please do leave me your comments on the group. And yeah, love you guys. Let's rock, guys. Let's rock. Let's do this. Oh, lastly, guys, from next year, I'm having a tour. So I don't know where you guys want me to come to first. I'm looking at doing Joburg first. I'm thinking Joburg, and then I do Cape Town, and then I do Durban, and then I come back to Eastern Cape, and then I go to Mpumalanga, Limpopo, so forth. So I'm going to be doing a national tour, city